Recession fears reverberate across the economy here in the United States and around the world as we saw a relatively weak jobs report this last Friday and then a meltdown in the stock market earlier this week, seeing all of this madness related to the Japanese yen interest rates, a carry trade. But there's so much more going on. So we're going to be breaking it down today, how this economic news affects commercial real estate and multifamily, and then we'll get a quick snapshot on where the multifamily market is as we are wrapping up summer of 2024 and looking towards the end of the year and into 2025. It's going to be a great episode you're not going to miss, and also you don't want to miss future episodes. So make sure you've liked this episode, you've subscribed to the Great Capital YouTube channel, and you hit the bell icon so you get alerted for new episodes. We're going to get into it. All right, let's go. Welcome back to The Gray Report, hosted again, as I am just about every week, by producer of the show and communications director at Gray Capital, Dr. Matt Bosnagel.
Hello.
How are things going?
Pretty good. Pretty good.
Wonderful. So as we were talking about just in the brief intro, markets all across the world have been in a little bit of turbulence this week. Things I think are settling out a little bit now. I don't think the volatility is nearly where it was. I think we saw the VIX kind of get into like the 60 range, which is like a tripling of where it was. The VIX volatility index, was kind of 14, 15, 16, and it just shot up. Which haven't seen that really since COVID. A lot of things technically were happening in markets that we hadn't seen since COVID or past crises or recession. Yet there doesn't seem to be one thing that someone could point to that was really the impetus for all of this. We could say it was the jobs report, right? That came in a little bit weaker than expected. The unemployment rate increased in the United States up to 4.3%, but 4.3% isn't really that high of an unemployment rate. It was just a little bit of a surprise. There's this whole idea of the carry trade with the Japanese yen, and Japan has kept interest rates so low, and they increased their 10-year treasury on yen to in the positive territory, and that apparently blew up. A lot of people doing an arbitrage trade, borrowing at 0% in Japan, taking it over, buying fixed income or whatever elsewhere in the world where they could get some real yield. That's probably, I assume that was a highly levered trade, and so there's a lot of cascading effects. We also have, the election and volatility related to the election, and I think some investors who were counting on a Trump presidency to lower taxes, lower regulation, generally create a maybe more positive business environment. Whether that's true or not doesn't matter, just more the perception. And now returning back to volatility, who's going to be in the White House or elected to the White House in November, and what does maybe a Kamala Harris presidency look like? Probably not as many tax cuts. So Matt, Axios has a nice article kind of summarizing a lot of this. Try to help us understand kind of what's happened over the last week, kind of where we're going, and how as multifamily investors we should make sense of it. Because the last piece before I let you go is interest rates. 10-year treasury finally below 4%. Got as low as 3.78%, Matt. I mean, that's the main index that we're borrowing off of. I mean, cap rates and interest rates, specifically the 10-year treasury, are somewhat correlated, not exactly, but essentially you might be able to pay up a little bit more on those multifamily properties. Folks who want to refinance, that's really good news. And then the idea that rate cuts in September are almost a certainty, and the market is now maybe saying, hey, more than 25 basis points, let's do 50, and then some calling, which I don't think would ever happen unless something else happened, for an emergency rate cut. And I think we're beyond that. I don't know if that ever got taken seriously, but
nothing makes Chairman Jerome Powell happier than to hear people calling for emergency rate cuts. And he's like, they want me. They really, really want me.
Well, is this kind of playing, taking a step back? Is this exactly what Jerome Powell wants to see, of people finally capitulating and saying, oh, no, actually, there is too much slow growth. There is no inflation. Maybe we're going to go into a recession. We really need to slow down. I mean, if not this, what was the goal and aim of increasing interest rates.
Yeah. In a way, now feels, maybe it's because of the stock market volatility, but the SoftBank fiasco in early March, or earlier in this year, that seemed like it was just one little piece of the economy. This seems a little bit more fundamental, or a little bit more, almost, as you described, overdetermined, which is to say there are multiple factors determining this, feeding into the situation that we're in. I do think that Jerome Powell is happy as a clam right now, because this is what he wants. He wants the pain. He wants the fear. And nothing motivates lack of, this lower prices really than a lack of kind of confidence.
Yeah.
And he's created that right now. He's created, well, essentially is maybe a little bit more risky environment in terms of like how unpredictable it is. But we were looking for this pain throughout, really even as early as 2022. We were like, where's the pain? We haven't felt it. 2023 didn't really happen, and now here we are. The Axios, one other factor, the Axios or other outlets have reported on it as a potential driver of recession is maybe the AI bubble has burst or something like that.
Yeah.
Add it to the pile. You got the carry trade. You've got the jobs numbers. Really, to me, the jobs numbers seem like such a big factor here. I don't know how much the Japanese, getting cheap loans in Japan and then using them and, using them in other markets or something like that. To me, like, jobs is like this fundamental thing. But a lot of the people like on Bloomberg and stuff this morning were talking about how actually the Japanese market, the Japanese interest rates are a big determining factor here. Regardless of which, kind of skipping to the implications for the commercial real estate and multifamily market, CRE Analyst has an interesting post that they made a couple days ago, and that was really my first reaction to this news on Monday as well. It was like, well, they started saying, sorry, low rates can be bad for real estate. I know that. So my first reaction was, well, maybe we'll get those low interest rates. My second reaction was, oh, wait, yeah, we're going to have to pay for it somehow. Pay for it in lower valuations, pay it for maybe in terms of lower demand, low growth, low rent growth, a number of factors that make it more, that chill investment. I mean, think about having to pitch a higher valuation to investors and buyers during an economic downturn. Ain't going to happen. Or at least wouldn't be quite so easy. Maybe you have to make a really killer pitch deck, but it's going to make a lot of people's jobs a lot harder. And I don't think that the relief of a lower expense growth would counterbalance the immediate hard effects of a recession happening for property owners, asset managers, let alone like brokers and people that are willing to buy and sell. That being said, the comments do highlight like, time to get your good basis right now.
Yeah. So, I mean, what you have to balance is lower interest rates. Mm-hmm. So the financing, your interest payment is going to be a lot cheaper, when you're owning that property. And right now, at least for the time being, prices are relatively lower than they were a couple years ago.
Yeah.
But can you stomach buying a large asset in a macro environment that might be slowing and negative, or even a recession?
Yeah.
When everyone's like, look, the economy is just no good right now, you don't know where, a bottom might be. Mm-hmm. And it's hard to not react to that fear. And a lot of investors will just, not want to do anything because, just the economy isn't good right now. Mm-hmm. And like, hey, we're just going to hold off. We're going to wait for some clarity. Although a lot have been waiting for clarity for the last couple of years, especially in terms of real estate. So I think that the other side of that is like what you were just alluding to, and we've talked about this in the last couple episodes, Matt, is that do you take the bet that, there are some, short-term headwinds in the macro economy, but there's a lot of demand for rentals, for housing, and the pricing is low. And if you look in a period of 5 to 10 years, there's actually a lot of growth, but in order to capture that growth, you need to have bought at these lower prices.
Yeah.
And so can you get through some of the short-term pain for the long-term gain? If you believe that there is going to be, a somewhat prosperous, decade ahead of us.
Yeah.
And that's not easy. But I mean, there was, looking at this week, it was a mixed emotions, because for that exact reason, I'm like, okay, if going to recession is not good for anybody, rents don't shoot up in a recession.
Yeah.
Multifamily is, relatively stable, but can definitely see some declines. We've already seen some rent declines. Could we see more? Possibly, depending on how everything shakes out. There's no guarantee that we're actually going into a recession, by the way.
Yeah.
But I mean, everyone that's been sitting on, floating rate, loan that's coming to mature, that 10-year dropped 40-ish basis points. And if you were on the edge, if you were one of those, because it's a spectrum of
Totally.
Stress and distress and prosperity. And if you were on the fence line of like, oh man, I'd love to refinance this. We need to refinance it. But we're right on the edge. And right now we've got to bring, X millions of dollars if we want to bring to the closing table to close this deal. And I don't want to go and make that capital call, or I can't make the capital call. This may have gotten you to a point of where, all right, now the deal works. Now it pencils.
Yeah.
I mean, I know, we're getting ready to close on a property, and our interest rate cap, the price of that, has dropped significantly. It was by a couple $100,000, and those are, real
Now,
savings.
Those numbers that you set with the bank when you're closing a deal, do those numbers get set right at the close, or are they agreed upon earlier in the process?
The spread is agreed upon. It's like, okay, we're going to give you, 180, 200 basis point spread, or on like a fixed rate over the 10-year treasury, the 7-year treasury, the 5-year treasury, or we're going to give you a 300 basis point spread, or 350 over SOFR, like at a floating rate, like bridge loan or something like that. So the spread is determined, but they don't typically say, as far on a floating rate loan, I mean, it's always going to be, floating, whatever the rate is that month.
Yeah.
Now you might buy an interest rate cap that will, is a separate kind of derivative product that is essentially a hedge against rising interest rates.
Okay.
And it will make a payment to you that will make up for some of the rise in interest cost.
Okay.
They're not perfect. You have to escrow to buy another one. They're short term. But that cost moves around and changes.
And we'll get into Fannie and Freddie in a second here. But if you were getting a Fannie and Freddie loan, would just at the same time that you said that there would be a spread, that happens earlier in the process. It does not happen at close. If you're getting a Fannie and Freddie,
the locking in the spread usually happens, at the application. Once you put in your application. But then to actually rate lock, you have to make a deposit. If you're going for a fixed rate loan.
Yeah.
It's typically, different lenders can be a little bit different. You try to rate lock as soon as possible. You kind of have to have the whole loan figured out to rate lock. Sometimes it takes place a week or 2 weeks before you close. Sometimes it can take, you can do it a month before, depending on how you and the lender are kind of getting through the process.
Well, maybe the new regulations will make that change.
Maybe. But yeah, you have to put a big deposit down, usually to lock the interest rate, and then at that point you're locked. You're fixed, and so it's that interest rate plus whatever the spread is.
Why didn't our business take a bunch of cheap Japanese loans and use them to finance our properties?
It's a good question.
Maybe the risk is a little risky. I feel like the
Do you see what's going on?
I feel like the process of exchanging that Japanese money into American money and then changing it back, you probably lose a lot of money in that.
Yeah,
right?
There's got to be some like drag and inefficiency. Because
everyone would do it. If it was super easy. I don't know. Maybe I just feel bad because I didn't figure out how to get the cheap loan.
It does kind of makes a lot of sense. It's like, all right, if you can borrow at one, and you put it into a money market account paying 5.5%, that makes sense. Or you put it in, private credit or something, you can earn, 8, 9, 10, 11, 12. You can make a lot of money, and then people are confident on that spread and they lever it up, and that's what happens. Why did we not do it? It's like, I'm not an expert in Forex and carry trades and that type of arbitrage. And it's like, you don't know what you don't know, because if someone would have explained it to me, 6 months ago, I'm like, sure, that makes sense. Then you do it. Then all of a sudden it's like, oh, well, yeah, because of this technical aspect, the whole, trade is, blows up, and you don't know, And that's why I keep investing in apartments, because it's what I know. And
we stay in our lane as much as we can.
Kind of staying in the lane. That doesn't mean you don't look out for other ways to get things done, but it's a little extreme.
Yeah. So kind of to get back to these recession signals, we got the so the Japanese carry trade, that's one thing. The jobs numbers are another, and the jobs numbers, I have said for many weeks that this was specifically worrying. A lot of people have been talking about the SOM rule as a recession indicator. Now, coined by Claudia Sahm in 2019, the SOM rule declares that when the 3-month average of the U.S. unemployment rate is 0.50 percentage points or more above the low of the prior 12 months, the U.S. is already in a recession. Now, that may or may not be true. It was coined in 2019, so it's not.
Yeah, I was going to say I mean, so many of the rules, the pre-pandemic are kind of because it's anything related to time. Because again, we've talked about this. I feel like that the time variable was kind of compressed.
Totally.
And it was kind of dilated and undilated, and like the notion of the idea is probably correct, but is like the time frame is as linear as
and Claudia Sahm, the creator, says that the current actually doesn't necessarily disavow the Sahm rule, but is kind of excusing it in this case.
Yeah, she's kind of saying like this is what's different about.
Yeah. And she said that the current rise in unemployment is due to perhaps like an immigration-fueled increase in worker supply. And because we're seeing more workers and not less jobs, we may not be headed in the direction of a recession. So the quote here that she says here is, a rise in the unemployment rate due to an increase in the supply of workers is different. The rate will decrease once the jobs catch up with the new job seekers and more workers allow the economy to grow more. So the Sahm rule does not distinguish between these two dynamics and can look more ominous when the labor force is expanding rapidly. So I was also thinking about credit card debt and other factors. We've talked about the Whipsaws as another factor for a recession. I think the Whipsaws is a little dated, but especially in light of like what has happened in the past 5 days.
Yeah.
But credit card debt is something that has been in the headlines. Oh, it's higher than ever before. Oh, you can't get behind it. Some people are just spending way too much right now. And I've looked at the numbers and you can see them right here. And consumer credit is really not alarming by any means. Credit card debt is increasing always. Aside from aside from like immediately after the pandemic and the years after the great financial crisis, it's almost always credit card debt is increasing.
And so we're looking at this chart, Matt. This is percent change from a year ago. So this is year over year percent change. Well, what gets people, and the only reason I'm showing this is I think this is we're making a point here.
Yeah.
But what other people, when they make the other point, which would be, just how much credit card debt there is, it looks a little bit different. It's going to do it. Yeah, it keeps going up. But you know what? It pretty much always goes up.
Yeah.
Just like the money supply, typically always goes up. As inflation, the price of a lot of things usually goes up.
The normal is that it always goes up.
The general direction, because again, like the dollar is getting weaker. There is inflation.
Yeah.
There's more people. Like our population is growing.
Yeah.
So the more people are going to take out, that's some of the more debt that they're going to have at some point, medical, credit card, car, student, whatever. And so the idea is it's like we have more credit card debt floating out there than we ever have before. It's like, sure, there's more people.
Yeah.
There's more credit cards. That makes sense. And so it's more of, again, not to say that like you're wrong, it's no big deal, everybody's fine, the consumer is fine and dandy. That's not what we're saying either. What we're saying is like, let's just kind of pump the brakes a little bit on pointing to some of these.
Yeah. If you look at the chart here, we're decelerating. The rate of growth of credit card debt is actually lower than it was, a year ago or any time.
And personal savings is that's another thing that people are pointing to of and this is
okay. So this is the one I'm really scared of.
Okay,
or at least it's definitely more worrying than the credit card debt.
I agree, and
it's getting a little bit less headlines actually. But personal savings is decreasing. This is the one that you should be talking about. People are knocking around the idea that now that personal savings rate has gotten so low, people are going to get into credit card debt more. That's actually not really happening yet. So there is these jobs, Japanese monetary policy, declining personal savings, vibes, the election. There's all these things that are combining and, in the mix of this like little recession stew. But there's also, a lot of headlines, which I'm sure you would see in 2007 and stuff, saying, oh, maybe it's not a recession. Maybe the Somme rule is not not in play.
For sure.
I think it's important for us to think of the implications of either situation, make an educated guess about long-term viability of the market, of the economy in general, and make our bets that way, because we have the luxury as multifamily investors to have a little bit longer timeline than the day traders that are worried about, the Japanese loans and stuff. And
absolutely.
It's if you were really, if you were these risky investors in a riskier market like the stock market, these past 5 days would be, tear your hair out, very worrying. But if you have a plan, then it's a little bit easier to see a light at the end of the tunnel.
Yeah. I think what you're saying makes sense, man. I mean, we really haven't seen saving levels this low since prior to the great financial crisis.
Yeah.
Now they were much lower prior to the great financial crisis. They were registering on this chart from Fred on personal savings rate, a percentage rate of 2, that even 1.4. Today where we're sitting, we're at kind of 3.4. It peaked in April of 2020, because what else could you spend money on? You were getting stimulus checks going everywhere, and it's been on a gradual decline, which would be expected to see. It's just we'd like spend all of it during 2022 because of all the inflation. All of a sudden we had to pay more for everything, and we had a little bit more money. Everyone had a little bit more money, so I think at first everyone was willing to spend a little bit more, and also there was a ton of discretionary spending that took place. People probably buying things they don't need because they just had the extra cash, and they were just spending it and not necessarily saving it like they should have. But we did see, a surge back, up until, May of 2023, of a relatively healthy, level. Over the last decade, we were typically over 5% on that savings rate. Basically just got above it for a second. Now we've come down to, 3.5%.
And to get back a little bit to the CRE analyst post, I think that there is another risk, not just in like thinking that things would be okay. It's their LinkedIn post talks about the fear that could be, that could accompany and could depress values because maybe investors are fearful. I also think that there could be a little bit of a false confidence. They don't note this in the CRE analyst post, but for multifamily investors, there could be false confidence in that we have been through a recession. And,
it's true.
And the multifamily prices did not dip very much at all. If anything, really nothing meaningful during the last recession, during the pandemic.
Real actual recession.
Yeah, like the pandemic lockdown recession, there was barely, it was barely felt in the multifamily market in terms of the prices of multifamily properties.
Yeah. But it's like, wasn't a real recession. I mean, it was, but it's because also we turned the economy off.
Yeah,
it was like self-induced, but everyone was getting money sent to them.
Yeah, and I would caution. I don't think that if a recession happens again, I don't think that the dynamics are going to be nearly the same as it was in the pandemic. So that's that's one word of caution, just to think that you've been through it. Maybe it is going to be different this time. It's not going to look exactly the same, especially since I looked too about so where were multifamily prices during the Great Recession of like 2008, 2007, 2009? They went down. It took 4 years from their. Now they peaked a little bit in the 2007, but the actual like effect of the recession, it took 4 years. For prices to come up. So it didn't crash as much as the stock market and every like kind of sold home values, et cetera. But it did take a little bit. It did take a hit. So there's something to be prepared for. I think that would be the very worst. I don't see.
Yeah. And, I think the next leg down, and I'm not necessarily calling for this, but again, I've talked about, I think there's a lot of capital that is floating out there trying to jump into multifamily.
Good point. Yeah.
But if all of a sudden, recession fears create any kind of forced selling of owners, especially ground up new development that's, in lease up, pre-leased, they're trying to finish it. They've just finished it, but they haven't taken out, the permanent financing yet. They haven't sold it. Those are the projects that I'm, most concerned about, because, they're typically not generating enough cash flow to service their construction loan. And I think a lot of those owners and developers are ready to like kind of move on and just get that get any capital back they can. And so if there's a lot of selling, it's not unlike the single family home market of where there's not a lot of volume, but prices are still staying up. Similar to the stock market has kind of been also. It's like there hasn't a ton of volume this summer, but the prices have still been like melting up. All of a sudden, if there is a lot of volume and there just aren't enough buyers in the market, and like right now, like we're a buyer in the market, and we're being told we're one of the few buyers in the market that are actually serious and getting things done. And so, especially for the more expensive properties, which are the new construction, brand new, larger deals, because again, it's like there's just not a ton of operators that are pursuing those like they were a couple of years ago.
Yeah.
Some institutions are starting to get back into the market. We should next week, Matt, we should go over a lot of the REIT earnings calls that happened, I think, last week, for the last 2 weeks, as they went into like what they're doing, kind of their acquisitions, and they're jumping back into the game. I mean, volumes in Q2 were like 40% more than they were in Q1, and REITs are getting back into it. Again, not a huge volume. We're buying just about as much as the REITs are buying, which I was like, we're kind of in the same spot as they were. So it's like, it's REITs, it's Blackstone, it's Cray Capital, and a couple other firms like us. And then there's not a whole lot of other folks that are out there until you get to the smaller deals, the, call it sub 100 unit or the older workforce housing sub 150 unit or so, that are, call it sub 15 million or sub 10 million. I think there's some of that still going, but there's a kind of a big gap. I think kind of like 20 to million and up.
That's interesting. So we've spent all this time talking about all the multivariate reasons why the economy may be going down, but it is ultimately worth noting that this discussion of recession has been going on for the past like 2.5 years. Arguably for the past 4 years.
Something. We just need to give a new name to it.
Yeah. And I mean, the word vibe session, it wouldn't have a session next to it if people's vibes weren't really negative about the economy. And I have spoken about this before, but how consumer sentiment, economic sentiment during the Great Recession, which I did feel really keenly, I felt like I was a little bit sour on the economy during that period. And it was always so strange to me that people during the past 4 years were much more down on the economy than they were during the Great Recession. I wonder if there's going to be a little bit more of a parity, or if like it's almost like a reality check now that they're seeing this in the stock market go down and all of these like hard numbers. Now people may be more hopeful that there's something at the end of the tunnel. I don't know. The fact there's so many reasons does make me a little bit worried, but the fact that we've survived and been resilient for the past 3 years is also very helpful.
Yeah, you always need to take a deep breath, and there's always somebody, and there's always data that could point to a potential, just calamity.
But again, if you look at, and I don't want to scare anyone more than they should be scared, but if you look at the unemployment just the pattern goes down, and it goes up, goes down and up, goes down and up, goes down and up. And then where are we? Are we right where we were in September 2007 or in January 2001? Are we ready for unemployment to go back to 7.5% like it was in July 1992, or is it going to go down again and real normalize? Because the pattern for the past 3 or 4 decades, we're looking here at a chart of unemployment from 1980 to 2024, and this pattern, it does seem very compelling that it goes down to this level and then it goes right back up. So we'll see there. That's your scary chart of the day. I don't have another answer to that either. I can't. Maybe it's immigration, like Claudia Sam says, but it's certainly worrying. And the only real compelling reason where I would kind of excuse this pattern right now is that we are in the most weird, messed up situation in the wake of the pandemic than the economy has seen in more than 40 years, I would argue. So the story's not over, and we could renormalize, especially, you could see this reaction. So unemployment went up to 15 and then it dropped back down.
Yeah, well, that's the thing, because I agree, and I think you make a good point, relative to kind of like the pattern and the technical side of like, look, it goes up and then it slowly melts down over
Yeah.
time, and then it kind of little
Oh,
pumps, and
good
then it
point.
starts, riding. But it's like, we didn't really have that, like,
Didn't have the meltdown.
but we also, it always spikes up,
Uh-huh.
and this is but it was quite a spike, and then yeah, we didn't really get the slow like burn down. It immediately dropped back down.
Yeah.
And so now it seems like we're kind of at this beginning phase of the crunch up, which, there's not too many cases where it just pops up a little bit and comes down. I mean, maybe in 1980, but then it eventually did pop up into, we have multiple recessions actually.
Yeah.
So again, I think we're in this case of, there's not a perfect analog, and the cycles of that COVID brought on, it disrupted those cycles in those periods. And again, comes back to, we went through years of growth within a single year. And then we've gone through, years going, the other way. We'll have so much economic, progress or lack of progress that it makes you wonder that, okay, usually like we wouldn't be ready for, another recession, but are we just on an accelerated, timeline, and just the cycles are going to be shorter until they average out longer again.
Yeah.
And I mean, we also thought, we had a technical sort of recession, although not, back was in 22, 23.
Yeah.
We had 2 technical negative quarters of GDP, but like, we don't call it a recession for a variety of reasons. It seems like commercial real estate and other sectors have been in, manufacturing has been in recession at some point. I think I would call commercial real estate, certain parts are not necessarily from like a pricing standpoint, although there's been an absolute correction in commercial real estate.
Yeah.
So like we have gone, because I hear like, we haven't gone through any pain. And I don't know if that's like that's entirely accurate.
Yeah,
I think there
point.
has been pain, whether that's on the consumer.
5 session, there's a pay.
Exactly. And all these commercial real estate operators who are handing keys back, that's some pain right there.
Yeah.
So I just think we're in a little bit of uncharted territory.
Because it's not going to be the old normal or the whatever the normal was during the pandemic. It's going to be some kind of 3rd, 4th, 5th order thing.
Yeah.
Yeah. And it's a little bit harder. I wonder if we're just going to see we're going to see a little bit of a wake, right? So we had that big spike, and then we're going to get a counter reaction, and then things will kind of normalize. But
I think that the optimists are correct more often than the pessimists, and I like being. Sometimes it's fun to be a pessimist and be like, "Oh, things are going to crash." That always gets the most headlines that people pay attention to. But then when things kind of go normal, everyone just kind of forgets about that call, and then
that's what we've always said for sure. Yeah,
and so I'm just cautious. Anytime anyone's like, "We're going to have a recession or a crash," you listen to everything.
Yeah.
But I mean, the recession call was 100% before, at the end of 2023. So, we didn't have that recession. But it's without a doubt that, like, as your chart on unemployment showed, recessions are inevitable.
Yep.
High unemployment, you can debate on what high is inevitable. It's just when. We're humans are decent at predicting that something might happen, but we're not great at predicting when.
Yeah.
And, so we could have a recession this year. We could have a recession in 4 or 5 years.
Yeah.
And we just have to take it one piece of data at a time.
I agree.
Matt, an interesting piece came out, I think first saw in the Wall Street Journal, though it's been kind of shared around other publications. Fannie Mae and Freddie Mac, this is according to the Wall Street Journal, are poised to tighten real estate lending rules. The move comes as federal regulators and prosecutors step up efforts to root out commercial mortgage fraud. This was really interesting, and this all kind of came out in the time when, treasuries were coming down and maybe financing was getting a little bit easier. But the agencies, Fannie Mae and Freddie Mac, they do about 40% of all multifamily loans. So they are major players. Also been controversial, sort of, I guess, recently, Matt, at least on the Gray Report, talking about how at least the current Biden administration, sees the agencies as the vessel to maybe effectively install some sort of kind of rent control, or how they may try to regulate the housing.
One of the levers.
As they are a quasi-governmental organization is the way they call them. There were obviously efforts in the Trump administration earlier to privatize Fannie and Freddie Mac. That those plans ended up going nowhere. But Matt, honestly, as I read through this, it's not shocking, as we know that there's a lot of fraud out there. But I guess get us up to speed. What about, are loans going to be harder to get going on in the future? Or
first off, this is the first part of my notes, and I still think it's good as a start. Fannie and Freddie declined to comment, and the Federal Housing Agency, which regulates the two entities, also declined to comment. So that's where how I would like to frame this is like some.
So this is just a leak.
Well sourced. I think that they're confident because the way that I was like, how did Fannie and Freddie purposely leak this information? Because the way that the Wall Street Journal reports it here, and as far as I know, the Wall Street Journal really got the scoop here, because other people are saying, no, Wall Street Journal found this. So they're saying it. So lenders would have to independently verify financial information related to borrowers for apartment complexes and other multifamily properties, according to people familiar with the preliminary plans. So these people familiar with the plans, maybe it's people that are Fannie and Freddie employees. Maybe it is people they work with that are like, hey, let me run this by you. Here,
Yeah.
But regardless, I'm wondering what the specifics of this plan is, because essentially what they're asking is stricter lending requirements and stricter. It seems like they're asking lenders to do more due diligence.
Yeah. So what I've gotten from reading the article is not necessarily that the actual requirements are going to be stricter, which that's what the headlines seem to portray, is that it's like we're going to be doing less lending. When I've read the articles, kind of summaries in this piece of the Wall Street Journal.
So not stricter requirements.
Yeah, I mean, technically they could be requiring, but it's not necessarily that we're going to, require
or like the standards.
It really is more related to due diligence and the verification. And in the past, or in the present, although they say that they have maybe stepped up things a little bit, is that the lender, whether it was like on a Fannie, like a DUS lender, like a direct underwriter and servicer, who they can kind of like originate, they underwrite it, and they ship it off to Fannie Mae for a thumbs up, or like in Freddie Mac, Freddie Mac actually does most of the underwriting.
So if you're a borrower, you don't call up Fannie and Freddie, you call up third party that's like, I got the hookup for Fannie and Freddie.
Yes, but then there's sometimes another third party.
Yeah, that's fun.
So those would be the brokers. So those would be the brokers. So so we're going to get a Fannie Mae or Freddie Mac loan. There are lenders that have licenses with Fannie Mae and Freddie Mac.
Okay.
They are originators. You don't call up Fannie Mae or Freddie Mac and they give me a loan. Like, that's not what we do. Yeah. I mean, it is what we do, but we don't do the origination.
Yeah, the origination.
And so like we'll call up one of our lenders that is a direct lender, like a DUS lender, which is like a direct underwriter and servicer to Fannie Mae. They have a license that Fannie's like, you're good enough to do the underwriting and ship it off to us for approval and committee. And then there's Freddie Mac, which is a little bit different, where Freddie actually does a little bit more of the work and it's not done directly. Fannie and Freddie are very similar in many regards, but difference in some of the details.
Yeah.
But then there are the brokers who a buyer will go to a mortgage broker, which is very common in residential real estate. And they'll say, well, I know like 18 different lenders, and I've got a couple agency lenders and some bridge, and I've got a life insurance guy and some bank loans and different properties. Different lenders will be more aggressive and offer slightly different terms. Yeah. And the idea is you're going to pay me more. You're going to pay me a whole additional percent usually, but I'm going to get you the best debt. Yeah. And because I've got all these relationships. And so in that case, there's like a whole other conduit and a step. And so what often happens, especially with the broker, sometimes with the lender as well, is that like a broker will take everything that the buyer has on the property and they kind of make their own package to present it to a lender to put the deal in the most favorable light.
So you're going to a broker and the broker's like, give me all your profit and losses and stuff like that.
Yeah.
And they're like,
rent roll, T12, financial statements.
I'll check it out and I'll tell that to the lender.
Yeah, well, essentially, but it's more than that.
Yeah.
They're putting together a whole like business plan and package of here's the borrower, here's the property, here are the financials, and
information and data that determine the terms of a loan.
Yeah, because the loan, the two big kind of factors, there's a lot of them, but the two big ones are, the loan to value.
Okay.
There's usually a limit on how much money we're going to give you relative to the value of that property, that the value is based on what you're paying for it, and then we verify with an appraisal.
Yeah.
But it also has to meet a coverage requirement or debt service coverage ratio. Yeah. The property has to be producing enough cash to pay the mortgage and then some left over. And so whether that's a 1.25 or a 1.3, that means the one is you can cover your mortgage. The 0.2 is you can cover 20% over that mortgage amount. So the more cash flow you have over the mortgage means more cash flow. It's generally a safer, less risky loan. They're basing all of this information on financials that are being provided from the property, which can be providing BS information, to the borrower, the buyer-borrower, who could be manipulating that information, to in this example, the broker that could be in many cases, maybe
if we're the worst case scenario,
likely because they're trying to compete for business and they're trying to show you how good of a deal that they can get you. And so they may be changing some of those numbers. Yeah. And then it gets to the lenders. And some of these lenders aren't fannies. Then it's getting to, a Fannie lender. Yeah. Who's underwriting it.
So there's multiple opportunities.
And then eventually it gets to Fannie.
Yeah. Yeah. So there's multiple opportunities for maybe the buyer to maybe make things look good.
Because there's the way that's been done, there's no real verification.
Yeah.
It's just like, well, the rent roll was forwarded to me. Here's the Excel document.
Yeah. And
they're opening up the Excel document and they're just looking at it and they're saying, okay, all right, sounds good. We don't have anything else to go off of. And so if it won't, you can't manipulate your loan to value really, because it's like, that's what you're paying. That's what it appraised for. Like that's on the settlement statement. But in recent years, especially the last two years, when interest rates have been higher, most properties were not loan to value constrained. They were debt service coverage ratio constrained. Yeah. Saying it's like, all right, yeah, you're at, we technically could go all the way up to a 75% loan to value, but there's only enough, if after you pay your mortgage, there's only enough cash flow to cover, 1.1%, 10% more of cash flow from the property. Yeah. Therefore, we need to decrease that loan to value and that loan amount so you can get your coverage ratio into a spot where we are comfortable with, it meets our standards, and we think that we're taking a healthy amount of risk. So if someone messes with a rent roll, and says that, the average rent isn't $1,200, it's $1,600. Your revenue goes way up. All the expenses can stay the same. No one checks on that.
No one checks on it.
There's no, the buyer has the option to do a lease file audit, to actually go through and read the leases and check on the files. That's not a requirement, but from anybody. Yeah. The lender isn't doing it. So they're not going and verifying. So what a lot of this is talking about, from what I understand, from what I've read, is less on, we want to do less loans and we're going to have lower loan to values and higher DSCR constraints. Yeah. It's that they are going to be more critical on evaluating the information that they receive and verifying some of that financial information. So it's not so easy to just BS. And it's because they found a lot of fraudulent things have happened. Notoriously, it's been written about a lot, so we can talk about it. A group called Meridian Capital Group apparently was doing this all the time, and they've been blacklisted from Fannie Mae and Freddie Mac. They were a broker, and they apparently were, again, what I've read, is greasing those wheels, possibly allegedly fabricating financials to get higher loan proceeds. And then they go back to their borrower and like, we're the best in the world. We got you all these loan proceeds. And I have personally had conversations with folks from Meridian Capital where they bragged to me about all the loan proceeds they got on these horrible deals.
Wow. That's pretty shocking. It's pretty brazen. And I am surprised that these rules were not either in place as a requirement or as kind of standard practice. My question is now that was just a bomb you just dropped. So I wanted to like wait for wait to get it a little breather. But I think the fact that these things were happening so brazenly and in front, pretty much predetermined their fall. Obviously, there's a crisis, and it's worth noting here in the article, they're not talking about office properties. They're specifically talking about multifamily. Fannie and Freddie, these are multifamily mortgages that we're talking about. So office is just another thing. This is a problem.
Well, because office, it probably is at least viewed like office. The lenders, again, I'm not an office expert, but they probably do look at the leases because there's only a handful of them.
So, and this is my question here, and this is what I was thinking as I read this.
In the terms are different.
They're talking about I'm wondering from a practical standpoint, what independently verifying financial information specifically would entail. So it's asking lenders, instead of lenders just accepting what they get from the brokers, borrowers, and saying, like, oh, well, looks good, bing. Are they going to have to hire a third party? If they have to hire a third party, to me, that's worst case scenario, because that's a whole bunch of jobs you just created. That's like, now I'm the verifier. Or lender's going to have to hire a guy that, a bunch of analysts to be the checkers of this financial information. Or do a lot of these lenders already do that? Like, all right, well, we're going to make this loan. We're obviously going to look over this a little bit. And, I'm just wondering what standard practice is right now and what's going to change in the industry by requiring a lot of this extra work. It may not be extra standards.
They could ask for a lease file audit or a third party to conduct a lease file audit. That would be one way to do it. That would be an additional transaction cost that the borrower would have to bear. It wouldn't like kill a deal.
Yeah.
You're usually doing that anyway.
That's
and so
what I wonder.
You're usually doing that like internally, like your own team, accounting team, or your property manager is doing it. But there's no reason. It's not rocket science. A third party could easily, one person could, go in and do that job.
Yeah.
It'll be interesting, if any, but what the requirements might be. It could just be hey, we need a sample of some of the leases. We need a verified lease. Maybe it's a statement. Because when you're buying a property, you have to be skeptical of the information you're receiving anyway.
Yeah.
The financials that you're given are cleaned up because you look at what outputs out of a property management or accounting system. It's very detailed, and then once you get it and you're looking at buying a deal, it's obviously been cleaned up and everything. Because there's above the line and below the line, and a lot of things can put below the line, and properties are valued on their net operating income, and everything underneath that net operating income is below the line expenses. And so, for example, CapEx, capital expenditures, those longer term costs, bigger projects. Well, if you're shifting a lot of your actual kind of routine maintenance into CapEx, it disappears from an expense line item and it drops below the line into CapEx. So it looks like you have a lot less expenses on the property. But the reality, you just made an accounting decision to capitalize that item. So you're still paying the money. What's important is the net cash flow. The reason why people don't show that is because that also includes your mortgage expense and legitimate things that aren't really associated with the next buyer, like partnership expenses or partnership travel or tax returns. Because it's I didn't choose to charter a private jet to go visit the property, and I'm not going to do that. So I don't need to factor that in on the normal operating expenses. The partnership decided to make that expense. They've paid for it. It's below the line, whatever. If you reseal a driveway or you replace a roof, that's not a thing that happens every year. So that can go below the line as a capitalized expense. You want to know what all those things are, and you have a line item, in your budget for capital expenses. But long story short, you always have to assume there's a little bit of manipulation going on. And sometimes it's not even nefarious. It's just we don't know.
And that's what I was thinking while you were saying this, the oppositional relationship between the buyer and the seller should ideally resolve a lot of there's no reason, don't lie here. They're going to clarify it because they're going to want to get a good price anyways. But ultimately, I do wonder, is this going to add more time for a deal to close, to wait for the lenders to verify things, or is it going to cost more, or is this just kind of duplicative work where, we're all, if you're doing a good job already, you just ship that off the lender and they'll be in and they will verify it automatically. I can't help but think that there's going to be a little bit more work involved in getting a deal verified. I don't, like you said, like I don't think it's going to kill deals, but you know what they said in this article when I was thinking, well, is this a big thing? And the article itself says the new multifamily rules, which could be rolled out as early as this summer, are in early stages and still could change. If they are enacted, they would represent some of the biggest recent changes in the way Fannie and Freddie monitor these loans. So sounds like kind of a big deal.
I think we just need to wait to see the details.
Yeah.
It could be, you know, I think reading the headline made me a lot more concerned that they were just gonna be much more tighter on you know, I don't know if their volumes or what. As I read through this, it all seems pretty like straightforward, and there is a lot of, you know, fraud. I think that if they required some sort of verification or third party check off on like a lease file audit, that's not that. I personally don't think that's that big of a deal. But what I read through, I was like, you know, obviously more work and it's going to cost more, and that's not great, but it's nothing that's like, oh, this is going to prevent us from doing deals by any means. But at the same time, you know, let's see what they actually propose.
Yeah. Man, straight up fraud, not good.
Not good.
Also, don't brag about it. You don't got to brag about it. Oy.
Don't get me started. All right. So on the last piece for today, we're going to be just doing a quick look at the National Multifamily Report from Yardi Matrix for July 2024. You know, we did not have the surging July as, you know, we have had in previous years. You know, decent, you know, May and June, but not as much as past summers. But then July really kind of slowed down.
This is a snapshot from a week ago, and this was written before the volatility in the stock market. And I have a feeling this would just have a lot of a different character than last week. Honestly, if you want to rewatch last week, I was in flux last week.
On the Gray Report?
Yeah, on the Gray Report. To be honest, I was like still really processing the sluggish current state of the multifamily market alongside this readily apparent signs of housing demand in general. And like that's kind of reflected here. Yes, multifamily growth is weak nationally, but there's these strong demand sides. That story really hasn't changed in a week, obviously. And it's worth noting here. So it may seem weird that the headline here for the Yardi Matrix report is like signs are hopeful in July. Couch this all in, we're still in this historic amount of surging apartment deliveries. So we got a lot of new apartments on the market, and we're just kind of keeping our head above water still, which is nice.
I think that's a good way of putting it.
And also we've got CBRE, Cushman & Wakefield, RealPage, all reporting a change in vacancy rates and what may end up being a real inflection point away from the trend of rising vacancies. And kind of, I'd like to emphasize this again, here, vacancies have been on the rise since mid-2021, which was 3 full years ago. And that rise in vacancies is only now starting to come back down. So even in the midst of this wave, we've got this demand to be kind of a backstop. But again, none of these positive signs of demand have turned up rent growth in a meaningful way.
Yeah.
Rent growth still slow and weak in 2024. Yardi Matrix has it up, like 0.8% and up 0.2% month over month. Noticeably lower than the usual summer rent growth boost. Apartment List, just by the way, recorded negative 0.8 year-over-year rent growth, but had the same month-over-month rent growth of 0.2%. Again, the story is apartment supply. But also, I'm thinking that a lot of people have hit their ceiling on what they're willing to pay, probably. $50 for a quarter pounder is not going to cut it anymore. McDonald's is putting back like a $5 combo meal. Affordability pressures are constraining people. And I feel a little selfish to suggest that the market would benefit from lower interest rates, but I said it last week, and I think it's becoming a more maybe a certainty, or at least more probable. Anyways, I think that this jobs report, as alarming as it is, those employment numbers, make of it what you will. I still think that there is a general health and a general strength in the multifamily market. Did you notice here in the numbers when you were looking at the market growth, Washington, D.C. is a standout market here. Month over month rent growth close to 1%, year over year growth close to 4%. is that an election year boost? Are people
Yeah.
are people getting like a 1 year? You're going to stay in DC for the election or not? And I looked actually supply. It's a supply story. I took they built tens of thousands of apartments less than Atlanta in these past few years, which has actually about the same apartment inventory according to CoStar.
Interesting. Atlanta and DC.
Yeah, according to the CoStar
Is it
number.
because the areas? Or?
It's probably because Atlanta isn't Atlanta like big
CBs?
sprawling suburban. So I'm sure they're connecting it.
Yeah,
to
and
the-
I know obviously in like Baltimore, there's a lot of where the growth from related to DC.
Yeah,
is
yeah.
going on as well.
But 10 similar apartment inventory and in
Because it's interesting
the Sun Belt
because
level.
Baltimore is like negative down here.
Yeah. Oh yeah.
Curious if that's a supply story here. Well, I think they've got
Yeah.
it listed here relative to supply. Okay, Washington D.C. completions of total stock 2%. See this nice 4% year-over-year rent growth.
Yeah.
Right now, where's Baltimore on this list? They might be on the other markets.
Yeah, but we can look at Atlanta.
Yeah, we'll look at Atlanta, but I'm just curious
Oh, yeah.
about if Baltimore is on here. Okay, yeah, let's look at Atlanta.
Atlanta's near the bottom.
Atlanta 3.7%. It doesn't show total inventory, but 3.7% of total inventory being delivered relative to, as you said. I mean, the completion total of stock 2%. I'd say that's not. It's not high. It's not super low.
Oh no, here we go. Baltimore. I had a 1.1.
Oh, did I miss it?
1.1%
Oh, yeah.
completions. Well,
Interesting.
again, lots of different reasons. I'd like to think that partly it's due to an election year boost, but that's just a fun little story. The report also mentions the strength of the economy as one thing keeping apartment demand high. Again, we're at a little shakier spot, but if I want, to repeat myself, the apartment market is a more stable place than the stock market. The underlying proposition of multifamily investment, which is the housing demand and fundamentals underpinning the space, really hasn't changed. I don't think that that's going to change. I don't think that even a recession, as hard as it could be, the worst realistic predictions of recession, that's not going to erase the housing demand or negate the out of balance housing supply in America right now. So we've got that. We've got that as a factor for a longer term investment than whatever a short term economic fluctuation will be. I don't, there's lots of different factors. No, I didn't even mention the Ukraine war or the war in the Middle East as potential factors, but there it is right there. So there's lots of stuff that could go wrong, but man, the size of what could go right for
It's always a lot that can go
the
wrong.
multifamily
What I
market.
see of-
Yeah,
Sometimes it does.
yeah.
But most of the time, it doesn't. Well, make sure you're subscribed to the Gray Capital
Yeah.
YouTube channel if you want to stay in the loop with all this type of information. And remember, we've got the newsletter, Gray Report newsletter. It's the OG newsletter covering commercial real estate research data, consolidating all the articles, sending them to you. Again, kind of the first of its kind. And Matt, I think this was a big props to you and the Gray Report. I don't know if you saw the news. But the Bigger Pockets podcast, one of the largest real estate podcasts out there, Brandon Turner used to be on it, and then David Green took it over when Brandon Turner kind of sort of left to do his own thing, raise money. Bigger Pockets has decided to move away from David Green, and they're moving, and they're bringing another correspondent who is been working for Bigger Pockets for some time, but it's solely focused on kind of data and markets. The Data Deli account on Instagram works for Bigger Pockets, but they're moving from what I read, the announcement, the format for Bigger Pockets is moving more closely to the Gray Report than it has been in the past. And when we set out to do the Gray Report, we said, there's a lot of great podcasts out there and YouTube shows that, are interviews with successful real estate investors or up-and-coming real estate investors, and tell me about your story and
how'd you get rich?
And how did you get rich? And tell me about your growth, which is all great and motivating content. You can learn a lot from those. I've watched a lot of those and been on many a podcast like that.
Yep.
But there's a lot of that, and sometimes it gets a little old because it's like the same stories. It's like, well, I read Rich Dad Poor Dad, and then I bought a duplex, and then wherever the story goes. But what was lacking is true commentary analysis on like the market and actionable information, not just motivation. And I think we started putting out the Gray Report newsletter. Then we started doing kind of what was like a newsletter recap, taking all the data and talking about it. Still kind of what we do. A little bit more kind of focused and pared down now. And then we saw like other newsletters that came out that's starting to be somewhat similar in accounts like CRE Analyst or CRE Daily, which both do just an awesome job.
Yep.
And it's all they do. We're a whole vertically integrated, private equity, real estate, hardware management. We do a bunch of stuff. They do a great job. There's plenty of room for it. But I think it's just kind of cool to see that other groups have kind of shifted to what we've been doing for the last, going on 4 years or so.
Yeah, totally. And, as we've done it, there hasn't been a week where we've been totally without words. Like something new happens every week. There's new data that comes out every week. And I'm consistently surprised at the amount of high quality information data that comes out for free from the multifamily market. And so it's a lot to digest.
Well, whether it's RealPage or Apartment List or Marcus and Millichap or, so many others, I think that us talking about these reports and making a big deal and sharing it and putting and giving them credit for, doing the research and putting it together, I think has been encouraging for them to do a better job, do more of it and put it out there and an acknowledgement. So I would hear this in the past. It's like, oh, we didn't know anyone ever read these things.
Oh, no, we do.
And it's like we do, and people do care about them. And one of the reasons why we started the newsletter and then the YouTube show and podcast is I kept, and people have heard me say this, I was getting frustrated when I would find an old report. And I was like, this report came out 3 months ago, 4 months ago. It's like, man, I'm glad I'm reading it now, but why didn't anybody tell me when it was first published?
Yeah.
And we needed the better dissemination of that information, not just to make a more efficient market, but just, knowledge is power, and you're going to make better decisions with better information.
And now that there is kind of a more active conversation about the data and the news and the research that's going on in the multifamily market, it makes dated and old data seem all the more old and dated. So the imperative now is to stay up to date, and that's what we've been doing, and that's what it's been easier and easier, it seems like, to stay on top of things. And I think it's because the multifamily market and the whole conversation just becomes seeded with a lot of great insights, data, and opinions.
Yeah. All right. Well, thanks for watching, everybody. Make sure you like and subscribe. Go pop on over the newsletter. Head to graycapitalllc.com/newsletter or grayreport.com. All right. We'll catch you on the next one.